Welcome. We're so glad everyone's here with us today. All participants are muted on entry, and we will unmute at the end at the Q&A. To get started, my name is Callie. I'm the Marketing Product Strategist here at OUCU Financial Credit Union. Thank you for tuning in to the Home Buying Seminar today on your lunch hour. We know that a strong foundation of financial education has a value beyond your bank account. OUCU is your dedicated financial wellness partner, and our mission is to help you. Buying a home is a huge deal. Today, our goal is to help you feel more confident during the process of buying your home. Like I said, we'll have time at the end of this presentation for questions. OUCU is the top mortgage lender in Athens County, so this is your exclusive opportunity to get your answers from our experts. For attending today, you'll receive $100 off closing costs. Our originators will have the names of those attending today, and we can guarantee that you'll be able to take advantage of this promotion. Thank you to our home loan team for offering this promotion to our members. And this offer will be good through the end of the year. We'll be sending out a recording of this seminar to all who are registered here in the next couple days. So now I'll turn things over to Kim Simmons, our mortgage originator, presenting this very informative and valuable home buying seminar for you today.
Welcome everyone. My name is Kim and I am a mortgage originator with OUCU Financial. I want to start by saying how excited I am that you're here on your lunch hour for our 2025 home buying seminar. Whether you're getting ready to buy your very first home or you're just exploring your options, my goal is to make sure you leave feeling today feeling informed, confident, and ready to take your next step toward home ownership. Here at OUCU, we truly believe in helping our members every step of the way, from the very first question about a mortgage all the way through to closing day and beyond. So today we're going to walk through the entire process together in a way that's simple and easy to follow. As you can see on this slide, here is what we'll cover today. We'll start with the mortgage process and what that looks like from start to finish. Then we'll talk about loan qualifications, what lenders look for, and what helps you qualify for the best options. We'll go over private mortgage insurance, often called PMI, and what that means for you as a buyer. After that, we'll look at closing costs so you understand what to expect when it's time to finalize your purchase. And finally, we'll talk about different loan types and why choosing the right one can make a big difference for your budget and long-term goals. Let's go ahead and get started with the very first step, the mortgage process. When people think about buying a home, the process can sound a little intimidating, but it doesn't have to be. At OUCU, we walk you through every step so you always know what's happening next. The home buying process begins long before closing day. It starts with learning what you qualify for, finding a home you love, and making sure all the right inspections, documents, and approvals are completed along the way. Looking at the mortgage process as a whole, first you're going to submit your application for pre-approval and obtain a pre-approval letter. Once you make an offer on a home and your offer has been accepted, you will work with your realtor to draft a contract outlining the details of the home purchase, which will be signed by both you and the sellers. That contract is then submitted to us, and from there, we place orders for your appraisal and title search. As this is happening, you may have inspections being completed on your home that are outlined in your contract. OUCU does not require that you have inspections completed, but you are welcome to add these to your contract as a contingency at your discretion. Once both the appraisal and title search come back and everything looks good, it's time to schedule closing. At that time, you'll work on finalizing your homeowner's insurance, and then closing takes place. At closing, you sign all the legal documents and you officially become homeowners. Let's start with the very first step, pre-qualification. This is where we help you determine your home buying path. It's a simple conversation where we'll talk about your income, debts, and what kind of monthly payment you'd feel comfortable with. Based on that, we can estimate how much home you can afford and what your potential loan amount might be. Pre-qualification is quick, easy, and it gives you a realistic idea of your budget before you start looking at homes. Think of it as your financial roadmap. It doesn't lock you into anything, but it gives you a solid starting point. Once you've been pre-qualified and you're ready to take the next step, we move into the application stage. The application is where things start to take shape. During this step, we'll collect personal information such as your employment, income, and credit details. You'll also review and sign the necessary disclosures, and the great news is you can do all of that electronically if you prefer. To help verify your information, we'll need supporting documents like pay stubs, W-2s, and bank statements. You can upload them directly through our secure online portal, send them via secure email, or even drop them off in person if that's easier for you. Our goal is to make the application process as smooth and stress-free as possible. Once everything is in, we can move forward to pre-approval. Now, this step is one of the most important. Pre-approval means that OUCU has reviewed your full financial picture, and we're offering to lend you a specific amount based on your verified income, credit, and down payment. Most realtors will actually require a pre-approval letter before showing properties because it shows sellers that you're serious and financially ready to make an offer. A pre-approval is generally good for 120 days as long as no changes have been made with your financial situation. Once you're pre-approved, that's when the fun part begins. You can start shopping for your new home. Once you have that pre-approval letter and you've toured a home that you absolutely love, you can then put an offer in on the home with your realtor. If your offer is accepted by the seller, your realtor will then draft a purchase contract. The contract is going to determine the purchase price of the home, any inspections that you're requiring as a contingency, if the sellers are going to be crediting you anything towards your closing costs, and all those different things. The contract will list all the property details that are part of the sale, including the address and parcel numbers, and it will also list your official close date and when you can occupy the property. The contract will be signed by both you and the seller of the property. Once you're under contract, we do ask that you send the contract to us so we can get your application updated according to the details of the purchase contract. Once your application has been updated, we reach out to you to confirm all the details and have you sign a packet of updated disclosures, agreeing to the changes to the application and allowing us to proceed with your loan. Once we have your contract and you've signed your updated disclosures, things start moving pretty quickly. If you had any required inspections marked on your purchase contract, you'll be working with your realtor to get these inspections done to make sure the property is in good condition. The most common inspections we see are pest, septic, and gas line if those are applicable. We'll require a copy of the completed and passed inspection report along with the receipt showing the inspection was paid for. The only inspection we do not require is a copy of the general home inspection. Again, OUCU does not require inspections be done, but we do require copies of the inspection reports if the inspections are required on the purchase contract. While your inspections are going on, we will also be ordering your appraisal and title services, which are typically ordered at the same time. The appraisal fee is one of the only fees we request upfront at the time we order the appraisal. Typically, this fee is around $725, but is subject to change based on price changes and the location of the property. If you do not have an OUCU account, we would have a member service representative reach out to you to open an account at this time so we can pull the appraisal fee from there. All other closing costs are paid at the end of the process when closing takes place. The appraisal is requested by OUCU to determine the market value to ensure the home is worth the price you're paying. So this is extremely important because we don't ever want our members to be overpaying for a property. If the appraised value comes back for more than with purchase price, then that's a really good thing. And that means you have some equity going into it from the start. If the appraisal comes back for less, then that gives you a reason to go back to your realtor to do some price negotiation with the sellers if necessary. OUCU takes care of ordering the appraisal for you, so you don't have to worry about finding your own appraiser to do this. A title search is also requested by OUCU from a title company to ensure the seller's legal ability to sell the home. So they're going to be checking for any encumbrances and voluntary liens, such as tax liens or judgments. The seller is obligated to transfer the title to the property clear and unencumbered. So that's where the title search is going to be coming in, to make sure that whenever you inherit this property, it is free and clear and you're good to go. The title company that conducts your title search is typically the same place you will go for the closing itself. Behind the scenes, our team at OUCU will be working closely with you, your realtor, and the title company to make sure everything stays on track and all documents are moving through the system smoothly. The final step is closing, which is the day you officially become a homeowner. Before you get there, you'll need to set up your homeowner's insurance policy and make sure everything required by OUCU is in place. On closing day, you'll sign all the final documents, pay any remaining closing costs and down payment, and get the keys to your new home. It's a big day, and our team will be right there with you to make sure everything goes smoothly from start to finish. Now that we've gone over the mortgage process, let's talk about what actually helps you qualify for a home loan. When we review your application, we're mainly looking at three big things: your credit score, your income and debts, and your down payment. All of these pieces work together to tell the story of your financial picture. None of them have to be perfect, but understanding what they mean helps you take control of your home buying journey. Let's start with the first piece, your credit score. Your credit score is a three-digit number that helps predict how likely you are to make your payments on time. It's based on your credit history, things like how long you've had your accounts open, how much debt you carry, and your payment habits. Credit scores range from about 300 to 850, with higher scores showing stronger credit history. Now, you might be wondering, why does this number matter so much? Well, your credit score affects your loan approval and how much of a down payment you might be required to make. So the higher the score, the more options you typically have. But if your score isn't where you want it to be yet, don't stress. OUCU can help guide you with the tools and resources to get on track before you buy your home. With a credit score, let me go back here. With a credit score of 660 or higher, we can look at a down payment of as little as 5%. If your credit happens to fall below 660, then a 20% down payment will likely be required. OUCU even has a first-time homebuyers program where we can do down payments of as little as 3%, but we would likely require a credit score of 700 or higher to qualify for this. So if we take a look at the example on the slide, it just goes to show how much your credit score can affect the amount you're required to put down. Someone who is purchasing a $100,000 home may need to put down $20,000 if their credit is below that 660 threshold. With credit above 660, we could do as little as 5,000 down, which is such a huge difference. If you have no idea what your credit score is or where to start, I recommend checking your credit report using our online banking and mobile app. On the main page of your online banking, you can see your credit score, view your credit report, and set goals which provide recommendations on how to achieve your desired credit score. Along with your score, lenders also look at your credit history, which is the record of how you've managed your accounts over time. Most borrowers need at least 2 years of credit history and around 3 active credit references, which can be things like credit cards, student loans, or car loans. If you're just getting started and don't have a long credit history yet, there are still ways to qualify. Sometimes we can use things like rent payments, utilities, or even cell phone bills to help show your ability to manage monthly obligations. Our goal is to look at the whole picture, not just one number, because everyone's financial journey is a little different. The next piece we look at is your debt to income ratio, or DTI for short. This ratio helps us understand how much of your gross monthly income is going toward debt payments. It includes things like car loans, credit cards, student loans, and your future housing payment. In simple terms, it's a way to see if the new mortgage payment will fit comfortably within your budget. Your debt to income ratio is calculated by taking your monthly debt obligations and dividing it by your gross monthly income. So income before taxes and insurance are deducted. The payments that we'll be including in your debt to income ratio are things that derive from your credit report. We also need to factor in your new mortgage payment in that calculation, along with the estimate of your property taxes and homeowners insurance that you will pay on the new home. Let's take a look at this example on the slide. If your total monthly debt payments are about $1,500 and your gross monthly income is $4,000, your debt to income ratio would be 37.5%. At OUCU, our lending guideline for most loans allows up to 43%. So in this example, that buyer would be well within approvable range. We want to make sure you have room in your budget, not just for your house payment, but also for the other important things in life like savings, vacations, or unexpected expenses. So when we review your debt to income, we're not just checking a box, we're making sure your payment is something that truly works for you long term. Now that we've talked about qualifying ratios, let's take a closer look at what's actually in a monthly mortgage payment. As you can see on this slide, there are four main parts. Principal and interest, which is the actual loan amount and interest you pay on it. Private mortgage insurance, or PMI, which we'll talk about more in just a bit. Homeowners insurance, which protects your property. And real estate taxes, which are based on your local, county, or city rates and typically paid twice per year. Homeowners insurance and property taxes are not included with your mortgage payment as OUCU does not escrow. When you close on your new home and start making payments, you will have already paid your first year's premium of homeowners insurance at closing. After that, you can work with your insurance company to set up a payment plan through them. Understanding how these pieces fit together helps you plan ahead and know exactly where your money is going each month. All right, let's talk about one of the most common questions we hear. How much do I need for a down payment? Your down payment is the portion of your home's price that you pay upfront at closing. It's important because it directly affects your monthly mortgage payment. As you can see on the slide, a higher down payment usually means a lower monthly mortgage payment because you're borrowing less. Your down payment is due at closing and can come from your own savings or in some cases from funds that are gifted by a family member. And the good news is you don't always need a large down payment to buy a home. Let's take a look at the different options. For first-time home buyers, the minimum down payment can be as little as 3% of the purchase price. For most other buyers, the minimum is around 5%. This is all dependent on credit as well. You can also use gifted funds, meaning someone, often a parent or relative, can gift you money to help cover your down payment or even closing costs. There are just a few documentation steps to show that it's truly a gift and not a loan. So whether you've been saving for years or you're just starting to explore your options, our team can help you find a program that fits your situation. Please also keep in mind that your down payment does not include closing costs. Closing costs will need to be paid out of pocket at closing along with the down payment. We'll dive more into closing costs here in a bit. If you're using a checking or savings account for your down payment, we will need to collect bank statements showing that you've had these funds in your account for at least 2 months prior to application. So for example, if you apply today, we would collect your August and September bank statements to show you have enough money for your down payment and closing costs. When looking at your bank statements, we will also be checking for any large deposits. Any large deposits must be verified and sourced. For example, if you have a large transfer from another financial institution to your OUCU account, we would likely require you provide the statement from your other bank showing the transfer leaving the account. As another example, if you sold a car and had a large check or cash deposit that you're wishing to use for your down payment, we would likely require that you provide us with a signed bill of sale verifying the deposit was from the sale of the car. These are all just things to keep in mind as you plan and save for your down payment. It's definitely wise to keep a paper trail for any transactions that you're doing prior to applying. Once you know what your down payment will look like, the next question many buyers have is, what about private mortgage insurance, or PMI? Private mortgage insurance, or PMI, is something that comes into play when you put down less than 20% on your home's purchase price. PMI is an insurance policy that protects the lender in case of default. But PMI also makes homeownership possible for many buyers who don't have a large down payment saved. It allows you to buy now rather than waiting years to reach that 20% mark. And remember, PMI doesn't last forever. Let's take a look at when it can be removed. PMI is included in your mortgage payment, and over time it can be removed once you've built enough equity in your home. Typically, you must pay PMI for a minimum of 2 years. OUCU will drop your PMI automatically once your loan reaches 78% loan to value, meaning you've paid down about 22% of your home's original value. When that happens, your monthly payment actually goes down because the PMI is no longer needed. So while PMI might sound like an extra expense, it's really a tool that helps more people become homeowners sooner, and it doesn't have to be permanent. All right, now that we've covered down payments and PMI, you're probably wondering what other costs to expect at the end of the process. That brings us to the next topic, which is closing costs. Closing costs are used to cover the cost of all services to legally transfer the property from the seller to the buyer. These include fees for things like the appraisal, title work, and legal documents. When you get to the closing stage, there are several one-time costs that you'll need to be prepared for. These include things like the loan origination fee, the appraisal, the title search, legal fees, recording fees, the settlement or deed preparation costs. Together, these are all known as your closing costs. A good rule of thumb is to plan for closing costs to be around 2 to 5% of your home's purchase price. For example, if you're buying a $200,000 home, your closing costs could range between $4,000 and $10,000, somewhere in that range. The good news is that OUCU will provide an estimate early on, so you'll have plenty of time to plan and budget. We'll make sure there are no surprises when it's time to close. Now that you understand how the process works and what's involved in qualifying, let's talk about the different loan types available. Every homebuyer situation is unique. Your financial goals, how long you plan to stay in your home, and your comfort level with risk all play a part in deciding which loan is right for you. At OUCU, we offer a few main types of home loans: conventional, adjustable rate mortgages, and construction loans. Let's take a look at each one. The first type is the conventional mortgage. This is what most people think of when they picture a traditional home loan. It comes with a fixed interest rate and a fixed monthly payment that never changes for the life of the loan. A conventional mortgage is best suited for buyers who plan to stay in their home long term, usually more than 7 years, and who prefer the stability of knowing exactly what their payment will be every month. It's a great choice if you want predictability and peace of mind. Once you're locked into your rate, that's it, no surprises. The next option is an adjustable rate mortgage, or ARM for short. This loan starts with a fixed period and then adjusts based on the market conditions. It's made up of two parts: an index, which tracks market rates, and a margin, which stays fixed. Together, those determine your interest rate after the initial period ends. An ARM can be a great fit if you know you'll only be in the home for a shorter period, or if you plan to refinance before the adjustment period begins. It often starts with a lower initial rate, which can save you money in the early years. The adjustable rate mortgage we offer is a 7-1, which means your interest rate stays fixed for the first 7 years, and then it can adjust once each year after that. Each adjustment has a cap, which means it can go up or down no more than 2% each year, which is a maximum change of 6% over the life of the loan. The third type is a construction loan, which is designed for buyers who are building a new home. This loan works a little differently. It's usually an adjustable rate loan, but it's a one-time close, meaning you only go through the closing process once, even though there are two phases, the construction phase and the permanent mortgage. The construction period typically lasts about 6 months. During that time, funds are drawn as your home is built. And once construction is complete, the loan automatically converts into your permanent mortgage. It's a great option for buyers who want flexibility and a smooth transition from building to owning. So now that you have a sense of the loan types available, let's talk about why choosing OUCU for your mortgage makes such a difference. At OUCU, we're proud to be your local lender. We're based right here in Athens County, and we care deeply about our community and our members. One of the biggest advantages of working with OUCU is that your mortgage stays with us from start to finish. You'll never have to wonder who to call if you have a question or need help with your payment. We offer a quick, easy online application, and you can track your progress at any time. Plus, payments are made directly through OUCU's online banking, so everything stays simple and convenient. We're consistently recognized as one of the top mortgage lenders in Athens County, and that's something we take a lot of pride in. It means our members trust us with one of the biggest financial decisions of their lives. If you're ready to take the next step or even just curious about what you might qualify for, you can apply online 24/7 through our website. Our application system is called Mortgage Click. So here is where you would submit your online application, which can also offer instant approval, and you can print that approval letter for shopping. There, you can also check our current rates and calculate potential payments using the loan consultant tool. And of course, if you'd rather talk to someone one-on-one, we'd love to meet with you. You can scan the QR code on this slide to schedule an appointment with me at your convenience. We can do virtual appointments, phone appointments, or we can schedule an in-person appointment at any of our branches in Athens, Logan, or Lancaster. We are typically in office Monday through Friday from 9 to 5, so feel free to contact us if we can help in any way. And as Callie mentioned, as part of joining this webinar, we also have a digital coupon for $100 off your closing costs. And that brings us to the end of today's seminar. Thank you so much for spending your lunch hour with us and learning more about the home buying process. I hope you leave here today feeling more confident and better prepared to take that exciting step toward home ownership. We will also be sending a recording of this webinar to everyone who registered, so keep an eye out for that. If you'd like to reach out directly, you can contact our mortgage team via phone or email using the contact information on the slide. And if you have any questions, feel free to throw them in the chat and we'll be happy to answer them. Thank you so much.
Wow, Kim, you did a great job. Thank you. I think if only one thing is crystal clear today, it's the fact that you are in good hands with the OUCU Home Loan team. One of my favorite parts you mentioned is the reminder that we service your loans in-house. I mean, it doesn't get any more local than that. So at this point, I can unmute everyone, or if you want to put your questions in the chat, this is your opportunity to get the answers that you need. So do we have any questions? Lots of great information. Thank you. Do we have any questions? Okay, here's one. What are the tax cuts, credits, or grants that we can be eligible for as homeowners?
If you're referring to your property taxes, I know there is like a, I forget the name of it, like since you're occupying the home, there is an owner occupancy credit that you're eligible for through the property taxes. I don't know how it works or what the amount is necessarily, but that would be something to talk to the county treasurer's office about, and they can give you some more information. And just a side note as well, a lot of times property taxes are public knowledge. So if you do see a home that you're interested in, you're more than welcome to jump on the treasurer's website, jump on the auditor's website, and put in that property address, and you can see what the property taxes are for the year. So that'll help you give a good estimate of what to pay.
Oh, that's a great suggestion. Additionally, anything cuts or credits for first-time home buyers is a question that's in the chat.
So the first time home buyer promotion that OUCU does is the 3% down. Typically we require a credit score of about 700 or higher to qualify for that 3% down. And then we also work with the Welcome Home Grant through the Federal Home Loan Bank. That typically comes around maybe once or twice a year, and they provide grants and things toward down payment and closing costs as well. I believe this year it rolled out around March, but I know the funds go pretty quickly. But that is one grant that we partner with, is the Welcome Home Grant. So you can always look for more information on that.
And that really is a great program. If anyone has questions that I'm not getting to, you can also go to your reactions and raise your hand. And like if you're on mobile and not able to access the chat, and then I can call on you, or I can unmute you and you can ask your question that way as well.
And you're also more than welcome to give me a call or shoot me an email when this is over. If you'd rather just ask your question one-on-one, I'd be happy to give you a call and or shoot you an email with all the information.
Here is a good question. If I buy a house, make sure, okay, I'm not muted. If I buy a house, live there for 5 to 10 years, still have a mortgage, but need to move for work, what is the process of selling the property to buy another one where I'm moving? That's a great question.
Yeah, that's a wonderful question. So whenever you sell a property, you have to pay the mortgage off on it with the proceeds of the sale. So if you still owe $100,000 on it, you can't sell it for $75,000 unless you plan to pay the remaining $25,000 out of pocket. Any liens that are on the property, which would be your mortgage, would need to be paid off, so that way the deed and the title can be transferred free and clear to the next buyer. Now, in terms of actually selling it, you could sell it yourself, post it on Zillow or whatever you want to do, or you can work with a realtor to go through the process of actually selling the home. And you would work with that realtor, letting them know that I do have a mortgage on the home, so that some of those proceeds will have to be taken off to pay that mortgage off.
Thanks, Kim. I have another question that came in. If my husband's credit score is lower than mine, how does this affect my approval?
So we actually use whoever has the lower credit score to determine your down payment. So that's a great question. So if you and your husband want to be on the mortgage application together and your husband has the lower credit score, we would use his credit score to determine that down payment. So if it is under that 660 threshold or something like that, it's possible that you'd still have to put 20% down. Of course, we send it through underwriting. We'll try our absolute best to get you as low of a down payment as possible, but there is that chance that if you have to put 20% down if the lower credit score is less than 660.
Yeah, that is really good to know, especially as you're kind of getting your documents in order and just having that expectation of how things are going to fall. I have another question here, but I'm still looking at the chat, seeing some more questions are welcome. But do you have to actively be in Ohio when you're purchasing the property?
You do not, no. So we work with title companies that can do mail away closings, is what we call them. So a lot of the legal documents that are involved in purchasing a home have to be notarized, including the deed, things like that. So a lot of our title companies that we work with can mail you the document package to have that signed and everything while you're outside of Ohio. The only thing is we're only licensed to finance homes within the state of Ohio. So you have to purchase the house. The house has to be in Ohio that you're purchasing. And for us to be able to finance it, it has to be considered your primary residence. If you wish to purchase an investment property or a rental property, that would be done through our business department, which we have a team that can help with that as well.
Wow, those are things I hadn't even thought of. So great questions. That is all of the questions in the queue. But oh, good. We have another one. Does a for sale by owner home change the buying loan process versus a home being sold through a real estate company?
Great question. So if you're purchasing a house that's for sale by owner, that just means you have to put in a little bit more of the legwork. So normally a realtor would be there for you to draft up that purchase contract, take care of any price negotiations, sign any necessary disclosures and things like that. If it's a for sale by owner, you would need to work directly with the seller of the home to draft that purchase contract up yourself and have any necessary disclosures signed. Now, when we go through your pre-approval process, I can provide you a list of everything that needs to be included in that purchase contract. So things like the property address, the parcel number, the county you're purchasing in, all that stuff has to be on the purchase contract, which I can provide you a list of everything that needs to be on it. And I can also provide you a couple documents that'll need to be filled out and signed by the seller. And then you would just forward those to me rather than having the realtor complete all of that for you. But it doesn't change the down payment, interest rates, nothing like that.
That's so good to know. And one thing that came crystal clear with that answer is that OUCU working with our home loan team, like they're clearly in your corner and they're going to guide you through the process. And they've done it before. And so you're just in really good hands. And that is exactly what I heard from that answer. You know, like there's more work, but I'm going to tell you exactly how to work through it. So awesome, Kim. I appreciate that. Oh, good. We have another question. Does anything change if you're doing a mortgage loan for building a house?
Yes. So if you're building a house, that would be considered a construction loan. That's kind of a different, it's a little bit of a different beast doing a construction loan in terms of purchasing the property, already owning the property, things like that. But we do our construction loan on an adjustable rate mortgage where it's fixed for the first 7 years and adjusts annually after that. You have to work with a general contractor, different things like that. Emily, if you want to reach out to me when we're done, I can give you all the information about our construction loans in Callie, or if you have her email, I can send her an email with all of that information as well so we can talk more.
Yeah, I can do that, Kim. I will get you that email address so you guys can pick up on that conversation.
Awesome.
Perfect. Okay, how much does the pre-approval application process impact your credit score? This is a really good question.
It is, yes. So the application is a hard inquiry on your credit score. Depending on how many inquiries you already have, it can affect it a few points. I will say that typically if you're wanting to get pre-approved, if you do a couple inquiries within a couple weeks, it doesn't affect your credit as much as doing a hard hit every 2-3 months, something like that. So it does impact your credit score a little bit. It's just hard to determine how much it's going to impact it.
And to follow up on that question, once you have your pre-approval, how long does that last?
Your pre-approval is good for 4 months.
4 months.
Typically once we get all the documentation and signed disclosures, we can generally issue a pre-approval within 3 days, typically quicker. And then 4 months it's good for.
Awesome, thank you. So I will give it just a few more moments here. Any other questions you have? Like I said, this is such a great opportunity to chat with Kim. And then, you know, if once we close things out, you still have questions, I can point you to her I think it was her email is in a lot of the communications that have been sent out, but it's also on our website. If you go to oucu.org, click on home loans, there's a lot more information on our website as well. So that's a really great resource. We also have a financial wellness center. It's a virtual resource that anyone is available to. It's on our website. So I think it's under the Learn tab. You'll see Financial Wellness Center, and we'll have a whole page dedicated to the steps it takes to getting ready to buying a home. And that's another great resource for you too. All right. Well, think it's a good time to close it out. Thank you all so much for joining us today. Thank you, Kim, for your expertise. I mean, this is truly very valuable. And we're excited to work with you all in the future. Thank you all for your time and enjoy the rest of your day.